Today, I want to talk about PayPal. We will take a look at an investment firm's thesis around the company, as well as discuss the effect that super investors could have on the stock price. And finally, we will discuss their net income as well as their shares outstanding and come up with price targets for 2024, 2025, and 2026. So if you enjoyed the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. Before we jump into all of that, let's go ahead and take a look at PayPal's stock chart. We can see that over the last 5 years, this stock is down over 34%. And from its highs in 2021 to where it's trading at now, this stock is down over 80%. And in terms of PayPal's top line numbers, they have grown immensely over that time period. We can see that back in 2018, they were bringing in around $15.5 billion. They have almost doubled that revenue number to $29.1 billion here today. And even profitability over the last 5 years has grown very quickly as well. We can see at the end of 2018, they were bringing in around $2.05 billion of net income. That number here today has grown all the way up to around $3.7 billion. And even despite all that top and bottom line growth, the stock is trading at levels that we haven't seen since 2017. And with the stock price being down in a major way, it's starting to attract investment firms like Wedgwood Partners. And personally, I had never heard of Wedgwood Partners. However, if you go on their website, you can get a little bit of information about their investment philosophy. They look for companies that have a strong management team that is shareholder oriented, a high level of profitability measured by return on equity, as well as consistent growth of revenue, earnings, and dividends. And finally, a dominant product or service that is practically irreplaceable or lacks substitutes. And if we're being realistic, a lot of this is just investment jargon, because when you look at PayPal, you need to understand a couple of risks. There are a lot of players coming into the market like Apple Pay, Amazon Pay, Google Pay that are all looking to steal market share away from PayPal. And this first one, the reason I highlighted yellow, it is not an irreplaceable product right now. They have established themselves in the market, but they are under a lot of scrutiny from this other competition that's coming into the market. Even with that, they are still doing a great job, like we just showed, of growing their revenue and earnings numbers. Year over year, we have seen a number of companies over the last 6 months actually show decreases in revenue. And the fact that PayPal is able to continue growing their revenue, even though those numbers have fallen into single digits, is still a positive in my opinion. And here we have a statement that Wedgwood released about their position in PayPal. PayPal holdings also contributed less to portfolio performance than most holdings during the fourth quarter. The total payment volume handled by PayPal during its most recent quarter grew 15%, which helped drive healthy revenue growth and 20% earnings per share growth. Critically, the company's new management team has significant opportunity to drive more revenue and earnings growth across the massive multi-trillion-dollar payments addressable market. PayPal's rapidly growing payment processing brand Braintree represents one of those revenue growth opportunities, either by raising prices, as the company had previously used low pricing strategies to establish a beachhead in the market, or by adding value-add services. PayPal's branded checkout remains the largest volume and profit driver for the business, and we expect this to continue to track in line with e-commerce growth in the near term, and eventually take share as the company rolls out new features to its over 400 million users and 30 million merchants. We added to our position with the stock trading at just 10 times forward earnings estimates during the quarter because there are many more long-term growth opportunities relative to most financial companies that trade for similar multiples and compared to technology companies that trade at much higher multiples. And the reason I wanted to discuss this article is because there are a few interesting points that they bring up. The first being around the payment industry. It is a multi-trillion-dollar market, and PayPal is just one of the players. And this is why you are seeing so many competitors coming into the market, is because of the growth that this industry is seeing and how little overhead these companies end up having to have. They have a lot of upside and are very profitable, and companies like Apple are seeing that and trying to get their own portion of the market. However, PayPal is the #1 player in this industry. We see that with apps on the App Store, and the fact that PayPal and Venmo are 2 of the top 5 apps in the Apple App Store. And the growth of the payment industry is really coupled to e-commerce growth. We are seeing e-commerce grow in a massive way over the last 5 to 10 years. And a prime example of this is looking at Amazon. In just the last 5 years, Amazon has grown their revenue from $233 billion all the way up to $554 billion. And like they also mentioned, that PayPal is trading at similar multiples to financial companies. However, it is more in the technology company sector. And a lot of these tech companies like Amazon are trading at very high premiums. But it's good to start seeing investment firms interested in PayPal. We haven't seen a lot of super investors come out and actually invest money into PayPal stock, even though the valuation is so low, which is a little bit concerning because we saw a lot of super investors jump into Meta when the valuation dipped very, very low. However, I think there is still a lot of time for PayPal to gain favor from super investors. So let's go ahead and jump into PayPal's numbers even further. One thing I want to mention before we go too much further is the numbers here on macro trends are actually net income numbers that are GAAP net income. We're going to be looking from here on out at actually non-GAAP net income numbers because it is a little bit easier to look at Yahoo Finance, and we're comparing and using Yahoo Finance's PE ratios. So it's important to understand what metrics are being used when you compare these. Otherwise, you could get a little bit confused with what's going on and why the numbers don't necessarily line up. And you can go on their earnings releases and actually find their GAAP and their non-GAAP net income numbers. So we could see for Q3 of 2023, they had a GAAP net income of about $1 billion. For non-GAAP net income, it came in at $1.4 billion. And for Q2 of 2023, their non-GAAP net income came in at $1.289 billion. For Q1 of 2023, their non-GAAP net income came in at $1.326 billion. And for Q4 of 2022, their non-GAAP net income came in at $1.417 billion. And this gives us a total non-GAAP net income of around $5.45 billion. And we are going to use this $5.5 billion of net income as a starting point for 2023. So with a shares outstanding of around 1.1 billion shares, that brings us to an EPS number for 2023 of $5.01. And $5.01 is slightly over analyst expectations of $4.95. They have a high estimate of around $5.02. So we're very close to that high estimate. And for net income growth in 2024, we are going to assume an 8% increase in net income. That'll bring us to around $5.9 billion. And shares outstanding, we're going to expect that to decrease by around 2.5%. That will bring our EPS number to around $5.55. And this sits right in line with analyst expectations for 2024, as they have an average EPS estimate of $5.51, a low estimate of $4.32, and a high estimate of $5.99. And a decrease of around 2.5% in shares outstanding is actually fairly conservative compared to what we've seen year over year. Year over year, we have seen the shares outstanding of PayPal decrease by around 5.1%. And in my opinion, if the company keeps trading at very low valuations, they're going to continue buying back their own shares. And in 2025, I am expecting their net income to grow around 15% to around $6.8 billion. Their shares outstanding at this point, again decreasing by around 2.5%, would reach around 1.04 billion shares outstanding, and this would bring their EPS number to around $6.54. And if we see interest rates drop in a major way over the course of the next 3 years, I think we will start seeing spending increase, and this is going to have a big impact on PayPal's business. And that is why in 2026, I have their net income increasing by around 20%, and this would bring their total to around $8.2 billion of net income, and their shares outstanding decreasing by 2.5% again to around 1 billion shares outstanding. This would bring their EPS number to around $8.05. So what we're going to look at next is actually valuation. And one thing to keep in mind is we are actually calculating trailing PE ratio. So right now, PayPal is trading at a 17.45 trailing PE ratio. However, over the course of the last year, it has traded all the way up to a 36 PE ratio. This increase in PE ratio mainly has to do with the fact that PayPal's earnings fell in 2022, and that obviously drives up the price to earnings ratio. However, I think that something more sustainable is anywhere from a 20 to 25. We're going to be conservative and say a 15. And with a PE ratio of around 15, this means that the stock price in 2024 could grow to around $83.23. In 2025, we could see that number reach $98.17. And in 2026, we could see the stock price hit $120.82. So obviously for them to hit those numbers, we need to see them continue to perform in terms of the EPS numbers that they put up. And their next earnings report is expected to come out on February 7th, and they have an earnings expectation of around $1.36 of EPS. And personally, I like PayPal a lot. I think the fact that the company is trading below where they were 5 years ago, despite the amount of top line and bottom line growth that we have seen, is absolutely insane. And that's why I am holding the company. I think that they have a lot of upside with very little downside. But do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. So I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day.